October 1929, the date that changed everything. One moment, the world is celebrating unprecedented wealth and endless prosperity. The next moment, fortunes vanish overnight. Banks lock their doors, families stand in breadlines. Millions lose everything they've worked for their entire lives. It happened so fast that most people couldn't believe it was real. But here's what most people don't realize. That same disaster didn't actually end in 1929. It never really went away. The forces that triggered that collapse, the patterns that destroyed entire fortunes and shattered the lives of millions, they're operating right now, today, in your world. Whether you realize it or not. Think about what's happening around you. Prices keep rising. Housing feels further out of reach every year. Debt keeps growing faster than wages. Your paycheck doesn't buy what it used to. You work harder, but feel less secure. Most people chalk it up to bad luck or poor timing. But the truth is far more unsettling. What's happening isn't random. It's not coincidence. It's the echo of a system built on risk, greed, and carefully maintained illusion. Before we go deeper into this story, and trust me, this story will change how you see every headline about money, markets, and your future, I need to ask you something. If you're watching this, you care about understanding how the world actually works. You don't want to be blindsided. You want to see the patterns before they explode. If that's you, hit subscribe right now. I release content every week that exposes the hidden mechanics of money, power, and economic systems. This channel breaks down complex financial history in ways that help you understand your own financial future. Subscribe, and make sure to turn on notifications so you never miss an upload. Because what we're about to discuss could fundamentally change your perspective on your money, your investments, and your future. Now, let's go back, all the way back to 1929. Picture it. The world is riding a wave of pure euphoria. Stocks are soaring higher every single day. But here's the thing, these aren't just rich people investing. Teachers are buying stocks. Farmers are buying stocks. Mechanics and shopkeepers and ordinary people who've never invested in anything are pouring their life savings into the market. Why? Because everyone around them is doing it. And everyone is getting rich. Newspapers are calling it the new era of wealth. The papers proclaimed that a new age had dawned. An age where the old rules didn't apply anymore. Technology was booming. The economy seemed unstoppable. Credit was cheap and easy to get. Politicians were promising endless growth. And behind all the celebration, something sinister was forming. Debt was stacking on debt. The entire system was held together by a single fragile thing: confidence. As long as everyone believed the good times would continue, the system worked. The moment someone doubted, everything would collapse. Here's the dangerous part. Most people didn't see it coming because the signs were everywhere. They just didn't know what they were looking at. In the years leading up to the crash, speculation had gone completely insane. It wasn't just limited to stocks anymore. Real estate was booming out of control. Banks were lending money recklessly to anyone who walked through the door. Companies were lying about their profits to attract investors. Consumers were buying luxury items they couldn't afford on installment plans, betting that wages would rise forever. The entire culture had shifted. Optimism wasn't just an attitude, it was the foundation of the entire economy. And that foundation was built entirely on borrowed money. People were borrowing to invest, borrowing to consume, borrowing because they believed tomorrow would always be better than today. They believed prices would always go up. They believed they couldn't lose. Sound familiar? Because we're doing the exact same thing right now in 2025. Like every debt-fueled party in history, it ended the same way. Suddenly, violently, without warning. October 1929. Panic spread like wildfire. Investors rushed to sell everything. Prices collapsed. Within days, billions in paper wealth that only existed on paper simply vanished, evaporated. The system that once looked invincible, the system that experts claimed was perfectly safe, cracked wide open to reveal a hollow core. There was nothing solid underneath. It was all illusion. But here's the part that matters for understanding your world today. The crash wasn't actually the cause of the Great Depression. It was the symptom. It was the moment when reality finally caught up with fantasy. The deeper illness was the structure of the economy itself. There was too much debt. There was too little real income to support that debt. And there was too much faith in rising markets that had no connection to actual value. The entire system was built to collapse the moment that faith wavered. And if you look carefully at today's economy, you'll see those exact same conditions repeating. The names are different. The tools are different, but the disease is identical. Instead of ticker tape and telegrams spreading prices across the country with delay, we have trading apps and crypto charts updating in real time. Instead of margin loans, we have credit cards, mortgages, student debt, and trillion-dollar government deficits. And the illusion is stronger than ever because it's powered by algorithms and central bank intervention instead of just human psychology. Modern economies don't work on production anymore. They work on consumption. But consumption depends entirely on confidence. When people believe the system is safe and will reward them, they borrow, spend, and invest aggressively. When they doubt the system, when fear spreads, everything freezes instantly. Credit dries up, spending collapses, businesses fail. That's exactly what happened in 1929, and it's what economists are quietly terrified will happen again. Because the real danger isn't the crash itself. Crashes happen. The real danger is what happens when trust disappears, when no one believes the system will hold. When people stop playing the game. That's when everything comes apart. Let's talk about debt. Because debt is the story of both 1929 and today. In 1929, household debt in the United States had soared to levels that economists thought impossible. People were buying cars they couldn't afford, radios, homes. They were betting their futures on the belief that wages would rise forever and prices would never fall. In 2025, global debt has exploded to over 300% of total world GDP. 300%. That means the world owes more money than it produces in an entire year. The pattern hasn't changed at all. We're still spending tomorrow's money to live today. We're still borrowing from our future selves. Back in the 1920s, banks were selling risky loans disguised as opportunity. They convinced ordinary people that borrowing was smart, that it was how wealth was built, that the risks were minimal. Today, banks do the same thing through complex financial products that most people don't even understand. Subprime mortgages, derivatives, collateralized debt obligations. The instruments change, but the psychology doesn't. The mechanism is always the same. Hide the risk, appeal to greed, promise easy returns. And when it collapses, claim it was unpredictable. Now let's look at inequality. Because inequality is the dark secret that every system tries to hide. Before the crash of 1929, inequality had reached historic levels. A small group of elites controlled most of the nation's wealth. They invested in stocks and made fortunes. Meanwhile, the working class survived on credit and hope. They borrowed to maintain a lifestyle they couldn't actually afford. When the bubble burst, the rich lost money, but they had cushions. They had backup plans. The poor had nothing. They lost everything. And they had no safety net. Look around now. The top 1% owns more wealth than the bottom 90% combined. 1% of the population owns more than 90%. Corporate profits break records year after year while wages stagnate. The middle class is squeezed from both sides. They need to earn more, but jobs don't pay more. So they turn to debt to fill the gap. They borrow to maintain their status. It's the same script updated for the 21st century. And when rates rise or the economy cools, that entire house of cards collapses. Here's another dangerous parallel. In the late 1920s, the Federal Reserve kept interest rates low to fuel growth and speculation. They wanted easy money flowing through the system. But then inflation started to appear, so they raised rates sharply. The result was a sudden liquidity crunch. Credit markets froze. Panic spread. The economy that had been booming suddenly couldn't breathe. Today, central banks face the same dilemma. Do they print more money to keep markets alive and asset prices inflated, which causes inflation and erodes savings? Or do they raise rates to tame inflation, which crashes asset prices, freezes credit, and triggers recessions? Either choice has catastrophic consequences. There is no winning move. It's a trap. History is repeating in slow motion. And every decision made by central banks plants seeds for the next crisis. Let's talk about speculation. Because speculation is the engine that powers every bubble. In 1929, people poured their life savings into stocks they didn't understand because everyone else was doing it. They'd go to brokerage houses and watch the ticker tapes. They'd see prices rising and think they were geniuses. They'd buy more. They'd convince friends and family to invest. FOMO, fear of missing out, was powerful even back then, before that term existed. The psychology was simple. Prices rise, you think you're smart. Prices fall, you realize you were lucky. Today it's meme stocks, NFTs, and crypto bubbles. The psychology is absolutely identical. FOMO, greed, and belief in easy wealth. When prices rise, people think they're smart. They post about their wins on social media. When prices fall, they go silent. The pattern is ancient. It repeats because human nature doesn't change. What changes is the speed and the scale. The Great Depression exposed one uncomfortable truth that nobody wanted to admit. When systems grow too unequal and too leveraged, they collapse under their own weight. The question isn't if, it's when. And if we're honest, most of the world's economies today are running on borrowed confidence. The signs are visible everywhere if you know what to look for. Record household debt, corporate defaults rising, governments printing money faster than ever before. But there's one key difference between 1929 and today. Back then, the financial system was smaller. It was national. When it collapsed, it took down millions of people. Today the system is global, everything is connected. A shock in one country ripples across continents in seconds. That makes the stakes infinitely higher. By the early 1930s, the illusion had completely shattered. Breadlines stretched around corners for blocks. Banks failed by the thousands. Families lost their homes, their savings, their entire futures. What began as a financial panic became a full-blown social crisis that destroyed the fabric of society. Governments scrambled to respond, but their tools were crude and ineffective. They cut spending to balance budgets, which only made things worse. They raised tariffs to protect industries, which triggered trade wars. And they watched helplessly as unemployment climbed higher and higher. In their fear of short-term chaos, they actually deepened the collapse. The Great Depression became a decade-long wound that never healed during the 1930s. It reshaped politics. It reshaped economics. It shattered faith in capitalism itself. An entire generation grew up believing the system was broken. They saw their parents lose everything. They watched politicians fail to help. That experience scarred an entire generation. But here's the uncomfortable truth that nobody wants to discuss. The same logic is visible today. When cracks appear in the system, when warning signs flash red, policymakers reach for the same tools: printing money, cutting rates, and promising stability. They treat symptoms, not causes. They apply bandages to gunshot wounds. The global economy now floats on debt that will never be repaid. It's held together by central bank intervention and public belief. And that belief is fragile. So fragile. When it breaks, history doesn't repeat. It rhymes. The melody is the same, but the instruments are different. Let's look at leverage and speculation more deeply. In the 1920s, leverage fueled the mania. Investors could borrow money to buy stocks, sometimes borrowing 90% of the value. If prices fell even slightly, their loans were called in. Margin calls cascaded through the system. Forced liquidation triggered a downward spiral that fed on itself. Everyone selling at once. No one buying. Prices in free fall. In modern markets, leverage hides behind complexity. Hedge funds, derivatives, and shadow banks magnify small shocks into systemic threats that can bring down the entire system. The mechanisms have evolved. The tools are more sophisticated. But the core danger remains unchanged. Too much risk, too little transparency. Too much confidence in models built on assumptions that break the moment reality shifts. When reality shifts, those assumptions implode. During the Great Depression, trust collapsed first in markets, then in institutions. Banks closed their doors overnight, leaving depositors with nothing. People had saved their entire lives, and overnight their savings were gone. In response, the U.S. government created the FDIC to ensure deposits. It worked for a while. It created confidence, but today the scale is different. Banking is global. When Silicon Valley Bank failed in 2023, panic spread instantly across borders. The same fear of invisible losses, of vanishing safety, resurfaced instantly. People worried their savings were at risk. They worried about institutions they thought were safe. That psychological fear still lives under the surface. Waiting. What made 1929 so dangerous wasn't only financial. It was psychological. The belief in endless progress had become almost religious. Prosperity was treated as destiny. It was assumed. When that myth broke, when people realized the system could fail, people didn't just lose money. They lost trust in the system itself. The danger today is similar. For decades, we've been told that central banks can control economic cycles, that policymakers can smooth downturns, that recessions are relics of the past. Yet every fix requires more debt, more intervention, and more distortion. Each rescue plants the seed for the next collapse. Each bailout creates moral hazard. Each intervention removes consequences from failure, which guarantees larger failures later. The Great Depression also revealed how interconnected global economies had become. When American markets fell, European banks, already burdened by war debt and reparations, collapsed. Germany spiraled into economic crisis. That collapse fed resentment, extremism, and political chaos. The world learned, or should have learned, that economic pain doesn't stay contained. It spreads. Fast forward to now, global debt exceeds $300 trillion. A crisis in one corner, a sovereign default, a currency devaluation, a failed bank can ripple instantly across the entire globe. The architecture is larger than ever. But it's no sturdier. If anything, it's more fragile because everything is connected. One failure cascades. In 1929, policymakers thought they could restore confidence with speeches and small interventions. They misunderstood the disease. It wasn't panic. Panic was the symptom. The disease was leverage. People weren't irrational. They were overexposed. Their bets were too large. The same applies now. Central banks flood markets with liquidity, hoping optimism will rebuild itself. But liquidity is not solvency. Printing money doesn't create real value. It delays the recognition of losses. And the longer you delay, the more violent the correction becomes. Here's another echo from history. In the 1920s, asset prices soared far beyond fundamentals. They disconnected from reality. Investors justified it by claiming this time is different. That new technology, new management, and new policy made the old rules obsolete. Sound familiar? Today, valuations stretch logic again. Companies lose billions of dollars yet trade at record highs because markets expect endless growth. The same optimism blinds investors to fragility. The names change from RCA and Bethlehem Steel to Tesla and unproven startups with no profits. But the psychology is absolutely identical. The story is the same. Debt bubbles always end the same way. Confidence breaks, credit tightens, prices fall, forced selling accelerates the collapse. The question isn't if. It's timing. In 1929 it happened suddenly. In modern times it may unfold gradually, masked by policy support. But arithmetic doesn't lie. If debt grows faster than income, repayment becomes impossible. If growth depends on credit expansion, stability becomes illusion. We're repeating the same structure that doomed the 1920s, only at planetary scale. Another similarity is inequality. Before the crash, the wealth gap was extreme. The rich speculated in stocks and made fortunes. The poor survived on installment loans and hope. When the crash came, the losses were distributed unequally. Today, inequality is worse. The top 1% own more than half of global wealth. Asset inflation rewards those who already have assets. Wages stagnate. Debt fills the gap. The middle class feels wealthier when home prices rise, but that wealth is borrowed. It's fragile. When rates increase, the illusion fades. The social fabric strains. We've seen this before. The Great Depression birthed populism and protectionism. People turned inward, blaming foreigners, elites, or systems they didn't understand. We see the same sentiment growing again. Distrust in institutions, anger at inequality, fear of change. Economic insecurity breeds extremism. History warns what follows when pain meets politics. Violence, division, authoritarianism. Those things follow economic collapse. Back then, governments tried austerity, cutting spending to restore confidence. It failed catastrophically. Today, leaders face the opposite trap. Infinite spending financed by printing money. Both paths lead to collapse. One through deflation and despair. The other through inflation and decay. Sustainable prosperity requires balance. Debt must serve production, not speculation. Policy must favor long-term stability, not short-term gains, yet political incentives reward the opposite. Elections happen every few years. Politicians care about the next election, not the next decade. So they kick the can down the road. They allow the problems to grow. In 1929, speculation was visible. Crowds gathered outside brokerage houses watching tickers roll. They could see the madness. Today, speculation is digital and hidden. Instant trades, algorithmic bets, derivatives stacked upon derivatives. The speed magnifies fragility. When sentiment turns, there's no time to react. Markets move faster than comprehension. The velocity ensures the next crash, when it comes, will spread before most people even realize it's begun. Perhaps the most dangerous parallel lies in psychology. Before every collapse, people feel safest. They believe in progress, technology, and control. They dismiss warnings as pessimism. In the 1920s, those who sold early and missed the final rally were mocked. They were called chickens. They were told they didn't understand the new economy. In 2025, those who speak of bubbles and risks face the same ridicule. Confidence blinds. Complacency builds, and then one day something breaks. A default. A failed auction, a sudden loss of liquidity. The illusion evaporates like morning mist. But history isn't destiny. The lessons exist. Diversify risk. Question consensus. Understand that value depends on trust, and trust depends on discipline. The system fails not when markets fall, but when people forget why they rose. So as debt mounts, speculation grows, and inequality deepens, ask yourself, are we wiser than those before us? Or are we simply repeating their mistakes with better technology? The answer may decide whether the next decade repeats the past, or finally learns from it. If this made you think differently about today's economy and our future, share your thoughts in the comments below. Are we wiser now? Or are we walking the same path in better suits? Your perspective matters because history isn't over. It's repeating in slow motion. And understanding the pattern could change everything. Thank you for watching both parts of this series. If you haven't subscribed yet, please do so now. We're releasing more content like this every week that breaks down the hidden mechanics of money, power, and global systems. Your support helps us reach more people and spread these critical lessons. See you in the next video.